Imagine stumbling upon a secret, a gateway to wealth that Wall Street guards like a dragon hoards its gold. This isn't about insider trading or the next hot stock. It's about an investing principle so profound, yet so overlooked it could change your financial destiny. What if I told you that unlocking the true potential of your investments doesn't require a finance degree or a Wall Street connection, but a simple, powerful trick hidden in plain sight? Intrigued? Let's dive into the world where wealth isn't just created, it's multiplied. You've been led to believe that the path to wealth through investing is paved with picking the right stocks at the right time. But what if I told you that the real secret to building wealth is much simpler, yet far more powerful than timing the market or selecting the next big winner? The trick lies in understanding the fundamentals of compounding interest and leveraging it through a principle known as dollar cost averaging. But before we dive into that, let's address why this secret remains so elusive. Wall Street thrives on complexity and the emotions of investors. The more complicated the strategies, the more people think they need experts to navigate their investing journey. And here lies the first part of the secret. The beauty of investing is not in its complexity, but in its simplicity. Compounding interest, often referred to as the eighth wonder of the world, is the process where the interest on your investment earns interest itself, leading to growth at an exponential rate over time. The key here is time. The longer you let your investments compound, the larger they grow, turning even modest savings into significant sums. Imagine starting with a small snowball at the top of a hill. As it rolls down, it picks up more snow, growing larger and gaining momentum. That's your investment growing through the power of compounding interest. The catch? You need to give it time and keep adding to it regularly, no matter the market conditions. This brings us to the heart of the trick: dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when they're high, smoothing out the average cost of your investments over time. This strategy turns market volatility from a foe into a friend. And there it is, the secret that Wall Street prefers to keep under wraps. Not because it's impossible to discover, but because its power lies in its execution. Patience, consistency, and the magic of compounding interest can unlock financial growth that many believe is out of reach. Now that we've peeked behind the curtain, let's dissect this trick piece by piece. You've been introduced to the power of compounding interest and the principle of dollar cost averaging. But how do these concepts translate into a strategy that the wealthiest investors have been quietly using to amass fortunes? First up, let's tackle behavioral finance. It's a field that explores how psychological influences and emotional responses impact investors' decisions. Here's a revelation. Wall Street banks on your emotions, playing on the fear of loss and the thrill of gain to encourage constant buying and selling. Why? Because that's how they make their money, on transaction fees and the spread. In stark contrast, the trick we're discussing employs emotional discipline as its cornerstone. By setting up a regular investment schedule, you're taking the emotion out of the equation. Markets up? You're buying less with the same amount of money. But that's okay. Markets down? Your money buys more, leveraging the downturn to your advantage. Over time, this strategy not only averages out your investment cost, but also reduces the impact of market volatility on your portfolio. Imagine if you invested $100 every month into a mutual fund or an ETF. Some months, the market dips, and your $100 buys more shares. Other months, the market rises, and the same amount buys fewer shares. Over years, these ups and downs balance out, and thanks to compounding interest, the value of your investment grows significantly, often outpacing the market's average volatility. This strategy shines when compared to the lump sum investment approach, where timing the market becomes crucial, and let's be honest, nearly impossible to get right consistently. Dollar cost averaging liberates you from this gamble, turning what many perceive as a market weakness into your strategic strength. Here's where it gets exciting. The true magic of this trick is not just in accumulating wealth, but in the peace of mind it brings. Knowing that you're systematically building your future, regardless of market conditions, can free you from the daily stress of financial news and predictions. In essence, dollar cost averaging is your financial compass, guiding you through the tumultuous seas of the stock market with a steady hand. It's about playing the long game, focusing on the horizon rather than the waves crashing around you. And that, my friends, is the trick Wall Street hides in plain sight. Not because it's complicated, but because its power lies in simplicity, discipline, and the psychological strength to stay the course. Armed with the knowledge of Wall Street's hidden trick, you're now standing at the threshold of transforming your financial future. But understanding the trick is one thing, implementing it is another. Let's break down how you can start using this strategy in your own investing journey, step by step. The foundation of this strategy is a diversified portfolio. Diversification isn't just a fancy term, it's your safety net. It means spreading your investments across different asset classes like stocks, bonds, and real estate to mitigate risk. In a well-diversified portfolio, when one asset class underperforms, another might outperform, balancing your overall risk. Start by assessing your risk tolerance and investment goals. Are you saving for retirement, a down payment on a house, or your child's education? Your goals and the time you have to achieve them will dictate your investment strategy. Enter ETFs and index funds, the unsung heroes of the investing world. These funds allow you to buy a small piece of many stocks or bonds, instantly diversifying your investment. Instead of trying to pick individual winners, you're betting on the overall market's success, which history shows is a winning strategy over the long term. Now, how do you practically implement dollar cost averaging? It's simpler than you think. Set up automatic investments through your bank or brokerage account. Decide on an amount you're comfortable with and an interval, monthly, quarterly, whatever suits your budget, and let automation do its work. This way, you're consistently investing without the emotional turmoil of market swings. Consistency is key. Whether the market is soaring or plummeting, stick to your plan. Remember, dollar cost averaging isn't about timing the market. It's about time in the market. The discipline to keep investing, even when the headlines scream doom and gloom, will be your competitive edge. And what about rebalancing? As time goes on, your investments will grow at different rates, potentially skewing your portfolio away from your original risk tolerance and goals. Periodic rebalancing, once a year is often enough, ensures that your portfolio stays aligned with your objectives, securing your financial well-being. Implementing this trick might seem like setting sail into unknown waters, but with a clear map and a steady course, you're not just drifting with the current. You're navigating towards your financial goals. The journey might be long and at times challenging, but the destination, a secure and prosperous financial future, is within reach. As you chart your course through the investing seas using Wall Street's hidden trick, beware of the sirens and whirlpools that could derail your journey. Let's navigate through some common pitfalls and ensure your voyage is smooth and fruitful. First up, impatience. In a world addicted to instant gratification, the slow and steady nature of dollar cost averaging and compounding interest might test your patience. Remember, the most successful investors are not those who seek quick wins, but those who play the long game, allowing time to work its magic. Next, the obsession with checking your investments constantly. In the age of smartphones and 24/7 financial news, it's tempting to monitor the market's every move. Resist this urge. Obsessive checking leads to emotional decision-making, prompting actions that could harm your long-term strategy. Set a schedule to review your portfolio periodically, but don't let the daily fluctuations sway your resolve. Another pitfall is the illusion of market timing. Many investors think they can outsmart the market by buying low and selling high on a consistent basis. The truth is, market timing is incredibly difficult, even for professionals. By adhering to a disciplined dollar cost averaging approach, you sidestep this pitfall, investing regularly regardless of market conditions. Lastly, neglecting to rebalance your portfolio. As your investments grow and market conditions change, your portfolio's allocation will shift, potentially exposing you to more risk than intended. Regular rebalancing, at least annually, ensures your investment strategy remains aligned with your goals and risk tolerance. Avoiding these pitfalls isn't just about preserving your wealth. It's about optimizing your journey towards financial independence. By embracing patience, resisting the urge to over-monitor, sidestepping the temptation of market timing, and maintaining discipline in rebalancing, you solidify your path to success. Your investing journey is unique, filled with personal goals and dreams. Remember, the trick isn't just in knowing what Wall Street hides, but in applying this knowledge with wisdom and foresight. Stay curious, stay disciplined, and let the power of investing work for you. For more secrets unveiled and myths debunked, Keep sailing with us here at the Capital Craze Network. Subscribe for more insights, and together, let's demystify the world of finance, one video at a time.